So good afternoon or good morning, depending on where you're dialing in from today. Welcome to this webinar, which assembles a range of industry experts to discuss why financial firms are moving away from a DIY-centric approach to managing their business footprint. As we see the next generation of co-located infrastructure evolving, we're going to be looking at what type of decision frameworks businesses need to adopt when considering a buy versus build approach, and how can firms address their sustainability credentials, as well as looking at how cloud can now play a meaningful part in the digital transformation of co-located trading landscapes. I'm Helen Disney, I'm a director at the Realization Group, and I'm going to be your moderator for today's session. We're going to be hearing more initially about the research findings of Celent's recent co-location report, and we're delighted to have with us Monica Summerville, Head of Capital Markets at Celent. Welcome, Monica. After Monica's presentation, we're then going to follow up with a panel discussion involving Jeff Mezger, who's Vice President of Product Management at TNS, and Eleni Coldrey, who's Business Development Director for EMEA at Equinix. So to kick us off, I'm going to hand over the mic now to Monica to give us some insights into the issue of build versus buy when it comes to managing trading infrastructure. Monica, over to you.
Thanks, Helen. And I do have a few slides. If we could go to my first slide. So thank you everyone for joining today. My name, as mentioned, Monica Summerville, and I head the capital markets research team here at Celent. For those of you who don't know us, Celent is a research and advisory company, and we're focused on helping our financial institution clients leverage technology across all of financial services, including insurance, wealth, asset management, and banking. TNS at Equinix commissioned Celent to research the use cases, drivers, and approaches to co-location of financial markets trading infrastructure across capital markets. So I conducted this research along with my colleague Nigel Cheatham, who's a senior analyst on my team. His research focuses on technology trends and the vendor landscape across capital markets as well, from the front to back office. His background is he spent around 20 years in the industry, a combination of the fintech community, holding C-suite and senior technology positions across a range of leading solution providers, and also led systems implementation teams at a number of large buy-side firms. As for me, I'm an engineer by training, but I've spent most of my career in capital markets, mainly front office technology, but a variety of roles on the buy-side, sell-side, industry research groups, and I've worked as a broker, having held US Series 7 and 63 registrations. So just to give you some background and hopefully convince you that we're qualified in order to undertake this research. Just if we forward it to the next slide, before discussing the actual report, I thought I would just clarify what we mean by co-location in the context of this research. So co-location, when discussed in general, usually refers to any time a firm places its own computer equipment in a data center managed by a third party. If the firm has its own computer in its own building or sort of in its own location, or data center is often referred to as on premises. If a firm is putting in the capital markets context, when firms put their equipment in with an exchange, it's technically exchange co-location, but that's the use case that really on a high level that we're looking at, is that sort of exchange co-location. So when I'm saying co-location, that's really what I'm thinking about, is that trading infrastructure that's put in near a trading venue. And the main advantage really in co-locating a trading venue's data center is gaining direct access and proximity to the venue's matching engine, the trading network, and the data. And as we'll see through this whole conversation today, that's important for a number of reasons. An early driver was around reducing latency, so getting to that ultra low latency, and that's just the time it takes to get messages round trip between an institution and an exchange, but the use cases have expanded since then. So with that sort of background in mind, if we move forward, just wanted to give some background as well as how we conducted the research to gather the data for the report. We used a combination of primary and secondary research methods, and in this case, the primary research involved a series of interviews with executives at trading firms who co-locate data providers, data center operators, and managed service providers as well. And this was all supplemented with desk research and existing Celent expertise. As is often the case when we conduct research, we establish a research hypothesis and then test this in the market. So in this case, we initially set out to validate that colocation remains an important deployment model for many capital markets players, and that the use cases are expanding, beyond that initial ultra-low latency trading strategy use case. So some of the expanded use cases we've discovered are around deterministic latency, comprehensive, accurate, the need for comprehensive, accurate, and precise time-stamped data, and then connectivity to other venues, to counterparties, and to cloud, which I know we'll be covering today as well. Next slide, please. So our report addresses questions in a number of areas, so mainly around common colocation use cases, the business and technical requirements when considering colocation, the role of a managed service provider, what a decision framework would look like when considering to colo on what we call, a DIY or managed services basis, also a sort of build or buy as well basis, and looking forward, what impact might the cloud have on this? We can move forward. The report found that challenges around technical and operational complexity, as well as the availability of important value-added services, were key drivers for firms who opt for a managed services approach. So the key value-added services that we identified through our research included offerings that really can help level the playing field for firms in this space. And examples of this is offering access to the latest networks and technology, simplifying access to data, and the ability to leverage specialist consulting and outsourced services on ad hoc or one-off basis. And then based on our conversations with trading firms and other colo users, we found certain key decision factors were in play when they were deciding to build or buy, and that includes things like the requirement for specialist expertise, whether there's a need, how much of a need for agility and flexibility, whether access to high-end network services is needed. There's issues around operational efficiency that come up quite often, and also the desire to future-proof. So that was the report in a nutshell. Handing back to you, Helen.
Thanks so much, Monica. That was a really interesting overview of both the methodology and also the sort of beginnings of how you were putting that together. I know obviously there is a full report. Can you just let people know in the audience how they can access that? I presume there's a full report they can download once the session is finished. Will that be available?
The report is available through Celent directly. That would be for our subscribers, but TNS is also making the report available through their website, I would assume, and I'm sure that everyone attending this webinar will be given full information and a link to how to access that.
Great. So yeah, we'd encourage anyone who's joining or anyone who registered but didn't join, obviously, to download the report. Some of you may be watching this on the recording afterwards, so just to let you know that is available. So we're going to come now on to our panel discussion, and any questions about the report or relating to the panel, if you want to ask a question, please do feel free to put a question into the question box, and we'll come to those towards the end of the panel. But I wanted to kick it off by turning to Eleni just now, and obviously colocation has been around for a long time, but could you just explain a bit more about how colo is evolving and what the common use cases are when it comes to capital markets?
Yeah, sure. Thanks, Helen. So I work at Equinix, and I've been here for just over 10 years, working with our capital markets customers, both in EMEA and across our global platform. And you may be aware that Equinix is home to a number of exchanges and trading venues. So I think at the last count, we were allowed to officially say over 170 trading venues at Equinix around the world. So we've seen a lot of the changes that have happened in the industry. So I think when I first joined the company, we were still in what I would call kind of phase one, which would be the proximity phase. And subsequently, we've moved into the network aggregation phase and through to build on that into the transformation phase. So in the very early days, when exchanges were just opening up access from colocation facilities, really the people that you'd expect to see in a colocation facility alongside an exchange would be those with real latency requirements. So it would be the proprietary traders, the prop firms, market makers, the data vendors that needed to get the data out there. And you would expect them to have, kind of a minimum footprint. So we'd expect a small colocation deployment just with the key algo servers that had to talk to the exchange. So that was, a fairly small audience and fairly small footprints. But pretty quickly over time, those firms realized that actually there were other applications that were sitting in their on-premise data centers that were reliant on some of the front office applications sitting in the colocation. So in time, more applications moved out of on-premise. I'm talking about pricing engines, talking about some of the risk parameters and things like that. And so each customer started to build up their footprint as they realized that it made sense to kind of group applications and not keep talking across a network that could be, 20, 30, 40 kilometers long. There's a lot of data moving around. So there's kind of that aggregation. So that was interesting as you start seeing the growth of those footprints. And then what we saw then in terms of a network transformation, kind of the next level, it wasn't just the low latency players that had interest in being next to the exchange, but because a real community, a breadth of service providers was operating in these colocation facilities, you actually found that choice of vendors created a real operational efficiency. So if you brought in your network equipment, you could quite quickly collapse your network and could take a best of breed approach and really quite significantly reduce your network costs. That still holds to this day. You'll find that many of the large banks, large trading firms have these core network nodes where they are accessing exchanges in proximity and then aggregating their regional access, perhaps for secondary exchanges that are elsewhere. So, but the other thing I think really is interesting about that network effect is the resiliency that brought as well to customers. And I think particularly a lot of the key moments of instability that we've seen in the markets, from 2008, all the other shocks, Brexit, etc. What we found is that having multiple providers is really key to your operational stability. So multiple prime brokers, multiple access to data vendors, multiple network providers, and again, putting yourself in a community gives you that choice to be able to add backup, add resiliency. So there's a lot of kind of risk mitigation as well as cost takeout that firms benefit from. And then the final piece, from proximity play, network aggregation, the third one being transformation. And I think that's the phase we are well and truly in for the last 5+ years, is what's sitting in legacy on-premise data centers and how we're going to optimize that for the next kind of generation of digital services that our customers need to deliver to their end customers. And part of that's cloud transformation, part of that is just a second generation of systems. Part of it is driven by the sustainability agenda, but that shift from legacy systems into next generation. And so we're seeing a lot of co-located deployments in hybrid cloud formations and multi-cloud. So some of the examples would be around the use cases, for example, a risk management platform. So running your grid compute internally is, if you had to build and build and build for it, to manage the levels of compute you need to keep up with all of the regulatory requirements, that soon becomes cost prohibitive. But equally, if you were to take that grid compute and run it entirely in the cloud, that's also economically not viable. It's also, there are issues around the data sovereignty and security of the data. So what we see is a hybrid cloud where the data that is feeding the risk systems is being generated in colocation next to the exchange. So take that over a short fiber into the risk platform, and then use the cloud for compute, for burst capabilities, etc. But really managing the performance, the security, and the networking costs. So we can give other kind of hybrid cloud examples, but those are some of the transformative projects that we see at Equinix.
That's great to hear, and I think we're going to come on a little bit later on to talk a bit more about cloud and about digital transformation, because obviously that's a big element of this. Just to let people know, there is also a copy of the report in the handouts section of the control panel. So if you do want to download it from there, you can also get it during the webinar. I wasn't aware of that until my colleague just told me, so I just thought I would let people know. So coming to TNS now, Jeff, what are the requirements for traders and service providers when it comes to considering co-location? What do they need to consider?
Yeah, and Eleni touched on a number of them, but like any other real estate transaction, it's primarily location, 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 and not just the geographic location, but it's, as Eleni pointed out, it's where is the critical mass of a community of interest. And exchanges, but also the trading counterparties, vendors that you work with. It's about finding a location where that critical mass of the community exists, because, as Eleni mentioned, it makes it more cost effective and simpler to connect to all those counterparties, and particularly the exchanges, which, latency is still a key factor in choosing that location. It's not just about the ease of access, but it's the access in as low a latency manner as possible. And, obviously, would you say 170 exchanges? Obviously, Equinix is kind of pacing the field in terms of creating those communities around the world. You need to make sure that from a technology perspective, you want to make sure it's a modern data center with modern and reliable power delivery, diversity and resiliency built in, high-end security, but also amenities. Increasingly, we're seeing data center providers, and particularly Equinix. It's not just about selling space and power, it's what other services are available in that location, whether it's the Equinix fabric or the ECX cloud connection capabilities. You take those into account as well. It's not just about the location itself, it's what can you do once you're in co-location. Do you have the infrastructure in place to connect not only the markets in that co-location facility, but in the away markets, and bring in the away market data, which, the data rates are increasing and Opera's getting up near 40 gigabits per second of data. You need a big, robust network to bring that data to the co-location facility. Do you have that in place in a reliable and cost-effective way? Do you have hardware and equipment on hand to build out the space? Do you have the expertise on staff to do that? And especially as we look at kind of the growth of the global approach to trading, where firms are looking abroad more and more to deploy their equipment, that's where you really started running into challenges with, do you have the relationships with local hardware providers? Do you have personnel in region that can provide the support, provide the smart hands troubleshooting that you need when things inevitably go wrong? So, there's a couple hundred more factors, but those are the key ones I think that people take into account when they're looking at where to co-locate and whether to co-locate.
I think that brings us on nicely to my next question for you, which is, obviously we've seen lately a number of exchanges and venues moving their data centers. For example, Euronext moving from Basildon to Bergamo, as well as the London Stock Exchange moving its data center. So you've obviously touched on some of them already, but what considerations does this throw up? And how's that changed your client's approach to a managed service offering?
Yeah, these data center migrations are big, expensive, intrusive projects, right? And they're projects that are imposed upon you. It's not, when you sit down to plan out your roadmap at the beginning of the year, you don't necessarily plan, we're going to have a 3-month exchange migration in here. So, they're intrusive to, our customers' core business, which is, trading and participating in financial markets. They're complicated and expensive, especially when you look at something like the Euronext Bergamo migration, where it's taking place in another country. So it's not just about, boxing up your kit and trucking it down the road and installing a new data center. It's, to a large extent, it's about building out new relationships, new suppliers, as I mentioned, new smart hands firms, possibly new telecommunications providers. And one of the main challenges we're seeing play out right now is, with the semiconductor shortages and supply chain issues around the world, some of our vendors for hardware and networking equipment are quoting 9-month, 12-month lead times now, where it used to be 2 to 4 weeks. So when you talk about the timeframes you're working on, it's seen these migrations take place over an 18-month period, which sounds like a lot of time, but when you're now talking about a full year to get equipment, that puts a serious risk in just being able to complete the migration, let alone all the work and effort that goes into it. And I think one of the key factors that people are starting to realize as part of these migrations is, that, as I mentioned, they're expensive. How most firms approach these migrations is you build out a parallel environment. So that means that for some period of time, you have to have twice as much hardware and pay for it. You have to have telecommunication connectivity into the new data center and pay for it in parallel. sometimes you have to pay for the space and power, not in the case of these two migrations. The exchanges cover that, but there are a number of costs that you have to carry in parallel during this migration. Not to mention just logistics of actually performing the migration, moving your servers down, working with the exchanges and making sure you understand their technology, configuring your systems to work on the new platform at the new location. And all this is work that is not core to running a trading firm or a financial business, right? It's not work that directly impacts the bottom line. So I think it's definitely, when you have events like this, that's definitely where you start to see that decision of, you certainly, firms evaluate, is this the time to do it yourself, or is this the time to look at working with a managed service provider partner? And these types of events definitely tilt the needle towards the MSP model, just because, as I mentioned, they're expensive and it's a lot of work that's not necessarily your core competency or core to your business. So in those cases, it usually is, better, more cost-effective to outsource.
Yeah, I mean, all the risk and all the cost, it must be a very difficult decision to make. Eleni, you wanted to jump in there, I think.
Yeah, I was just going to add to Jeff's point and say, I think on the managed service provider thing, I think there's a lot of added value in terms of the analysis of how to split up the application stack. Looking at the Euronext move, so primarily looking there at the equity and derivatives markets, but the equity piece, the key European poles for equity trading were London and Frankfurt, right? And you can throw Zurich in there as well, but it's Deutsche Börse, London Stock Exchange Group, CBOE, Euronext. And we had a lot of customers. We know that they were, I think particularly some of the American firms, they might have their diverse equity nodes sitting in London, or perhaps one in London, one in Frankfurt, and then suddenly Bergamo comes on the map, and you have a triangle that you have to figure out. Where are you going to place the different components of your trading infrastructure? And if you think about just a smart order router, right? Are you going to place that in London? Are you going to place an instance in Italy? How are you going to reconfigure that to account for the geographical distance between your markets, with that massively changing? And so I think a deep understanding of the new network routes and the networking into the exchanges, that's where companies like TNS really provide the intelligence and also then the capacity to build out what you need, because it's no longer a straightforward the London and Frankfurt kind of equation.
Yes, I think things are becoming more complex, aren't they? As you say, geography, various different factors coming into it, the technological side of it obviously being a big part, and data being again another huge part of it. Monica, coming back to you, as part of the report, I understand you created more of a decision framework for firms to actually kind of figure out whether they should go for a managed services approach or build their own solution, DIY. Can you just talk a bit about what the decision framework might look like? I think maybe there's a slide you've got that we can put up that shows.
Yeah, if you could pull that up, that'd be great. And this is in the report. This is just what you're going to see on the slide is a small extract of the decision framework that runs across several parts of pages of the report. And as both Jeff and Eleni have been talking about, the decision to colo, it sounds straightforward. Put your equipment in a data center and off you go, but it's it's extremely complex, right? You've got all the network connectivity to think about, you've got the network environment and ecosystem to think about, and then you've got your whole trading application stack to think about where you place components. So it is very complicated. And in the course of our research, we did speak to a number of users of colo, and we realized that they were in different parts of their colocation journey, so to speak. So that was one sort of way that we looked at the framework. And then there were certain typical sort of actors that we encountered. So the decision framework is an attempt to kind of say, okay, where are you? What type of firm are you, and where are you in your colocation journey? And then what are the typical business challenges that you might encounter in that part of your journey? And then the decision framework helps you sort of look at the decision, the business challenge there, and then what the two options offer you from a pro and con basis. So it's really resolves down to what researchers like to do, put things in a matrix. So we have a 4x4 matrix here. So the four main colo user types that we identified is the startup trading firm. So this is a relatively new firm looking to enter markets, probably hasn't coloed before. for whatever reason. Then we have established trading firms that typically, are co-locating, are active in certain markets already. And then we also spoke with market data service providers and trading platform service providers who also have unique needs and requirements around colo, and we set that. So that's one part of the 4x4 matrix. The other part is to set that against 4 consideration points. So we looked at the business issues. So we identified sort of common business issues depending on the point in the journey, as I said, across colo. So there's business issue to address, and there's the potential impacts of that issue on the business. So what are the impacts? Is it cost or complexity or staffing? And then we looked at the approach by a managed service provider versus the approach if you do it yourself. And in some cases there's pros and cons, there's considerations to both approaches. So we took that matrix and we applied it against the sort of, as I said, the journey in colo across 4 areas, another 4 areas. So there's the cost of entry. So again, when you're sort of entering a market initially, overall the time to market, and then growth into new markets. And it could be, a decision the firm has made definitely to go into a new market, or perhaps they're testing out a new market. So when firms are making that decision, what are the considerations? And then I think Eleni mentioned this need to consolidate infrastructure over time. As people become more sophisticated with their colo, the infrastructure grows. They've moved, they've probably started moving more and more into the colocation facility. So there is an opportunity to consolidate that infrastructure, and there are different approaches. So as I said, the decision framework goes through all of those things: the cost of entry, time to market, growth into new markets, and this need to consolidate infrastructure over time in the matrix format that you can see here.
Thanks so much. It's really interesting to see it laid out like that. And I guess one thing that I wanted to ask Jeff is, I guess part of this is also how high tech your solution is. So if you're thinking about, for example, layer 1 high tech solutions, how realistic is it for those types of firms to actually build their own solutions? What are the pros and cons of build versus buy if you're in that area?
Yeah, well, I mean, anything's realistic if you have enough money to throw at it, right? Just ask Elon Musk. It depends on, it certainly cost is a factor. It depends on what your starting point is in terms of how much expertise you already have on staff and on hand to work on these projects or investigate these technologies. And arguably one of the biggest questions is time to market. For your strategy, for your business, do you have weeks, months, years in some cases to spend dedicated to understanding the technology, evaluating the vendors, and actually building out a solution? So those are kind of the factors that come into play when making that build versus buy decision. And with technology, newer technologies, and as you mentioned, layer 1 switching, it's not a one-time project. It's not, we put in the work and research it and we build this out and we're done. It's an ongoing project, because the vendors make changes, they come out with new features, and you have to keep pace with the rest of the industry, because in a lot of cases, it's an arms race. It's where you're trying to keep up with every other firm that's looking at the same technologies. So it's a constant process that's always ongoing, and it can be labor intensive and money intensive to keep up with it. So that's where a firm like TNS, we spend years working with these vendor partners, not only to really understand the technology, but to customize it to an extent, right? So that it's fit for purpose and works in our environment and for our use cases. So it comes down to that decision of its cost and time to market. There are some perceived benefits, which as a service provider, I would try to dissuade people of the opinion of benefits of DIY from that new technology perspective. I think some claims would be that you can achieve lower latencies and more reliable performance if you go a DIY model. Like I mentioned, we worked with these vendors for years to work through any of those challenges and make sure that from a performance perspective, we are on par to the extent we can be with a do-it-yourself approach. I think there's to a large extent one of the factors that goes feeling of control. People feel that if they control their environment end to end, that can lead to higher uptimes, higher reliability. It's a trust thing. Do you trust that the provider is provisioning and configuring your environment the way they're telling you? So I think, the key aspect of that is just having confidence and trust in the partner you select, to give that visibility and shine a light on what's being built out. So you have confidence that what the service provider is doing for you is, as good as it would be and identical to what it would be if you were to go build it yourself. And if you can get to that level of comfort, there's obvious cost savings to partnering with a provider to investigate and deploy these new technologies. And as I mentioned, time to market, trading opportunities are fleeting. If you can build out the solution in a matter of days or weeks, that they're going to have obvious benefits versus possibly taking months or even years to investigate and do it yourself.
Yeah, and I guess the other question is the geography aspect, which we did sort of touch on before. Eleni raised that. How does the managed service approach in that regard in terms of access to additional markets?
Yeah, I mean, it's, these are global operations now. And with that come the challenges of a global operation. Certainly when you're looking at dealing with exchanges, with hardware vendors or smart hands vendors, certainly I think anybody who's on this call knows each exchange is unique, right? Understanding and navigating their technologies, their platforms, their legal requirements, their commercial requirements, what options are available from a connectivity and functionality perspective. Every single one of them is a project unto itself. And when you start looking at this from a geographic perspective, you do start running into language or cultural barriers that can make that even more challenging than if it was in your native tongue. And that applies across the board, as well to sourcing hardware and just even understanding how to do that. Do you source it locally? In which case you have to go find a vendor and possibly establish a local entity and all that work, or do you source it in your home office and then ship it, and then you have to understand any of the logistics or customs or tax implications of that. So any way you slice it, those are difficult. And that's why from a service provider perspective, we're fortunate that we have local personnel on the ground in each major city in which we operate that speak the language, that know the culture, that work in that time zone. And all these things just make it so much easier to just get the answers to these questions. But also, again, from that time to market perspective, you can do things same day because you're working in the same time zone as all these partners versus having to wait 24 or 48 hours for an email response or a phone call from another region in order to progress your project.
Yeah, I would just emphasize what Jeff is saying. I mean, never underestimate the challenges logistically of dealing with some new markets you want to enter, and I think that's particularly true in the current investment environment that we're in, where finding alpha, finding margins in an increasingly tight business model is really challenging. And so we definitely see a lot of our customers trying to get into new markets or trying to extend into different asset classes they might not traditionally have been in. And I think there's kind of twofold there. One is if you're testing out some of these new markets, whether that be a new geography or a new asset class, leaning on a vendor that can very quickly get you into the market and can give you that kind of flexible contract is really helpful. But then also just knowing that they have that breadth there so that you're ready to go for a more permanent solution is really helpful, because it's, whether it's our customers trying to do business in Tokyo or, hardware issues like sourcing and the import taxes in Brazil, these markets increasingly, some of the markets that we're in are, from a capital markets perspective, be seen as kind of secondary markets or emerging, but actually increasingly our customers are wanting to go there. And so definitely you need a helping hand to broaden your footprint. So I think that's a really important service that partners like TNS provide.
And the other thing that's helpful when you're looking at it from a global perspective is you want things to be standardized globally as much as possible. You want your service in Singapore to look the same as it does in London, and not only working with a service provider but also a partner like Equinix, where connecting to the cloud can be a nightmare if you don't know what you're doing in each region. You have to go find a different way, or you can work with somebody like an Equinix and they present one way to connect to public cloud providers globally, right? So having that standardized stamp and repeat approach to building out your infrastructure is also key.
Yeah, and I wanted to also come back.
I was just going to add quickly that it's not just the technology that's rapidly changing, but the market structure is very much in flux. We're seeing, I think, as in response to a lot of the technology innovation, but also in response to a lot of the regulatory change, we are seeing real influx of new markets coming up all the time. And to Eleni's point, you know, some of the trading firms that we spoke to, they really appreciated that ability to focus on experimenting in new markets or trying things out, dipping in and out, and maybe even from just a learning point of view. So if it's easy to enter a market and set up, sometimes they're saying, well, sometimes we just want to learn about this new market structure or this new market and see if it makes sense for us. So it's not always just about the technology. I think we do have to, you know, recognize this is a period of, you know, very exciting times for capital markets, but exciting times means lots of change as well.
Yeah, I think it's quite disruptive, and I guess cloud is one element of that I wanted to come back to. Really turning to you a bit, Eleni, to talk about what the impact of exchange or venue migration to the cloud might be on the colo market. I mean, I guess, you know, they used to say video killed the radio star. Is cloud going to kill colo? Is that where things are going?
Yeah, it's a popular question, definitely one that we spend a lot of time discussing, and I guess the audience here will have seen fairly recent announcements of Google investing in CME Group and NASDAQ announcing partnership with AWS, etc. So yeah, there's a lot of talk at the moment about the major exchange groups and their transition to public cloud. And again, I'd like to make the distinction between public cloud and private cloud. Sometimes they get lumped together, but you know, you can have your private infrastructure in cloud form, and equally the public cloud providers are offering private versions, so AWS Outpost or Azure Stack that you can run in colocation. So a first distinction, but I think there's a bit of digging to do behind some of the press and the announcements that are made. So if you look firstly at the timeframes, like how long the transition period is that is being kind of touted in terms of, you know, CME moving to Google, you know, it's like a 10-year contract or whatever it was, you know. And so when you start digging, there may be an intention for the matching engine, which I think is what people are most concerned about or questioning. There may be a plan for the matching engine to move into public cloud, but there's no commitment around time frame. And you know, I think that's for a number of reasons that people would appreciate moving into a cloud or virtual environment where a whole ecosystem of trading firms is trying to access a centralized matching engine. You know, questions of deterministic latency pop up pretty quickly. You look at the major exchanges, and you know, from regulatory pressure, the majority do have equalized cable lengths, so that anyone in the colocation facility is at exactly the same distance, whether that's 600 meters or, you know, whatever it might be. But if you're in the building or in the campus, you're at the same physical distance away, and you can't create that today in a public cloud environment. So that's not to say they won't fix that question, but that is a key concern, not just of the exchanges, but of their trading communities as well. That fairness of access, but also the predictability of the latency, which is really critical for their trading algorithms. So there's a way to go there. So we'll see where that goes. And clearly, crypto exchanges, there are exchanges in the cloud today around digital assets, but not in our major exchanges in the equity derivative space. The other thing I would point out with these exchange groups is if you look at their revenue split, it's not all about trade execution, right? That's what we think about often when we're talking about trading, but there's a whole world of pre-trade and post-trade. There's a world of data and analytics, and you look at someone like London Stock Exchange Group acquiring Refinitiv, you know, data and analytics is a really big part of their revenue and arguably of the margin that they're getting. And the same with, you know, acquisitions in the post-trade space, you know, CBOE acquiring EuroCCP. So this kind of vertical integration of exchanges. So then the question becomes, well, what bit of the exchange is moving to cloud? You know, so there's a fragmentation there. And so I think for me, yes, that there's a lot of move into cloud, but really what the result is an increasingly fragmented landscape. So you have exchanges in colocation with some services in a cloud, and they'll have chosen a specific cloud partner like a Google or an AWS. But you have to work out which services where and how you access. And then you have the trading firms themselves who have legacy on-premise, which has got transformation question marks. You have their co-located presence. You have some of their applications that have moved to cloud, perhaps in the middle and the back office space. And then you have the data provided. So actually you get this fragmentation across multiple locations, multiple cloud zones. and to stitch all of that back together again so that it makes sense and you can make good decisions and you can make a cost-effective infrastructure base is just creating more headaches for people. And I think that's again where a vendor that can take a view and that can aggregate the expertise and resell their expertise to many customers, that's effectively democratizing access and democratizing the a higher level of service into the market. So yeah, I think there's complexity, and I think there's a way to go before we move to cloud. But finding the cloud edge and finding your edge and stitching it together is the big question mark.
Monica, I mean, we haven't talked that much yet about market data, but when you did the research, did you find that market data was a major consideration when firms were choosing between buy versus build, or was it more about connectivity? Was there
yeah, from the trading firm point of view, the access to market data is actually becoming more and more important. I think the need to run your own analytics, the need for the full depth of market and the tick by tick, and then really just having that precisely time-stamped market data as well. So that's the kind of stuff that you get by actually, again, locating at the exchange. So there's different models for receiving data. So you can buy data from an aggregator or a consolidated provider. Some of the providers that they specialize and actually they co-locate their equipment in the exchange and they provide really high quality feeds with that kind of precision time stamping. But I would say it's a very complicated field. It's getting more complicated every day, but we're seeing more and more interest in people looking and trying to understand where the raw data sets are and what they can do with that data in terms of an analytics point, whether they're using that to power their models and their analytics over time. You can imagine that there's different ways that, the volumes of data are so high, so there's different ways that you want to capture it and store it. And some providers, for example, will drop certain amounts of the data, especially if it's a fast-moving market, and you might not want to do that. Some vendors will correct data over time, and you might not want to do that. So being able to go to the source is very important for some firms, definitely.
So Jeff, when you saw the research, was there anything that jumped out at you in there that surprised you, or was it something that just sort of reflected the existing trends that you were already following?
Yeah, I would call it a pleasant surprise. That we certainly we work with our clients. We talk to them, we hear them. We know these trends were taking place in the industry, but it was a pleasant surprise to see that affirmed and reaffirmed in the study through the test. And so I wouldn't call it a surprise necessarily, but it was pleasant, reaffirming to see the trends that are unfolding or continuing to unfold.
Yeah, I mean, I think there's so much in there, and I definitely encourage people to go in and have a deeper look. And one of the additional trends that we haven't touched on properly yet is sustainability. Obviously, cloud is a huge trend, but ESG is another one, and they in some ways interrelate. So coming back to you, Eleni, I just wanted to ask what effect you think that cloud and I guess digital transformation more broadly will have on sustainability for firms operating in the marketplace.
Yeah, I mean, I think we all have seen headlines around, sustainability targets that are being made by financial services firms. Obviously, after COP26, there was large announcements from the major asset managers, etc. And there are definitely more and more financial services firms that are signing up to science-based targets. I mean, there's barely an RFP that we receive that doesn't mention sustainability as a key criteria, and I think it's maybe not quite up there with price, but it's definitely up there, and it can definitely rule you out of projects. So I think a bit like there was a lot of talk about being cloud first. I think there's a sustainable first kind of movement that's happening, and people are increasingly trying to dig into the solutions they're bringing. So sustainability as an agenda, I think that is creating some projects, and I think it is definitely steering transformation projects that were ongoing and that were, already in flight by a number of large companies. how much of a handle do companies have on their environmental footprint today? I think that's really mixed. You know, do trading firms actually know what they have sitting where and how it's doing? I think that's the first question. I think a lot of people would not too sure, and then what are you going to do about it? And I think, you know, moving from, you know, if we're talking about front office applications and we're assuming that they're in colocation, I think, you know, your colocation provider should be able to tell you, you know, the footprint that you've got already. So pretty much colocation providers should be geared up to hand that information across to customers directly. But for more of the middle and back office functions that might be sitting in legacy data centers, on-premise sites, there's definitely work to be done in terms of what, you know, how can you improve the footprint there. And typically speaking, you know, if you move it to a colocation vendor, I think you're going to find an improvement in efficiency and what you're able to report on, for sure. As a colocation provider ourselves, you know, it's not just a moral imperative to improve our sustainable game, but there's also a commercial incentive. If we manage our facilities more efficiently, then that's the cost saving. It's a cost saving around cooling as well as energy. So all of the infrastructure that is around the pure energy consumption by the compute, that's something that we have to manage. So if you're looking at, you know, numbers such as PUE, etc., you know, you can make good comparisons. And then, you know, when you get to some of the cloud solutions, Equinix has their own Equinix Metal, kind of a bare metal cloud solution. There, at a hardware level, you really can get increased efficiencies when there's liquid cooling. You can bring the PUE right down to 1.1, 1.15. And so all of that can then feed back into your science-based targets that you're committing to. So it's increasingly a driver of transformation, and it's always a question mark now. But the audience may have seen the recent launch of Sustainable Trading, which is a member network. I launched just last week, and Equinix is one of the founding members. But it's a network set up to very specifically look at the key ESG themes in the financial markets trading space. There's 30 founding members, including a number of exchanges, sell sides, buy sides, and they're going to be, you know, looking at what are the key themes and what is everyone worried about, and how are we going to find solutions and best practices. So I think it's, in this particular space of trading, it's an evolving conversation, but it's really encouraging to me that a lot of the brightest brains and the biggest pockets in the industry are looking at it.
Yeah, I'm glad you mentioned sustainable trading, because I was also going to say the same thing. I think the need for benchmarking is becoming clearer, and the industry has to work together on this, really, because it's not something that one firm can really do completely alone. It will work much better if there's more coordination and collaboration between different firms in the ecosystem. So there's a lot of work to be done, but obviously the priority is going higher up the agenda, I think. Obviously,
I think one of the interesting things in the member network as well is the representatives from the firms, and there's a really strong representation from the business leads, so head of equity trading, you know, head of, you know, certain asset management portfolios. And so having that front office commitment to these goals and participation in the working groups, I think, is really key. Of course, there's, you know, sustainability officers and infrastructure heads that need to come together, but I think getting commercial minds on it and those that are driven by the P&L of the business is really key to the buy-in of a successful transformation.
Yeah, absolutely. I mean, I think it's no longer a nice to have, it's becoming something that's, you know, built in to the way firms work. And we're seeing that more and more across industries, including outside of finance as well. So interesting developments. I guess one of the hardest questions, and maybe we can have a comment from all of you on this as we come sort of towards the close of the webinar, is, you know, with all these trends, you know, it's a more globalized market, you know, more market opportunities in different geographies, the cloud, sustainability. How can firms keep up with all these changes? You know, what's the sort of next opportunity as well for them to come to? So maybe, Jeff, we can kick off with you, some closing remarks.
Yeah, and I think it's largely what we've touched on. You know, the challenges that firms are encountering now aren't going to go away, right? They're going to accelerate, if anything, especially as Eleni mentioned, when you look at either the emergence of cloud, both public and private, or you know, sustainability, There's going to force new technologies. It's going to force new designs and behaviors. This trend's going to accelerate. It's not going to slow down. And what I talked about earlier, that constant need to investigate the new technologies, not once, but on an ongoing basis, and make sure you have a solution that works, that's fit for purpose, and that you can manage. That problem's always going to exist. So, not to make it too much of a sales pitch, but that's where, the role of managed service providers serves in the industry, right? Is we take on that burden again to let you focus on, which is not research technology necessarily. It's running your business, running your training business, running your investment business. Whereas we have expertise on staff to continually to evaluate those technologies and stay ahead of them, and make sure that we're always bringing the latest technology to bear in our solutions in the market.
Eleni, maybe you can come to this next.
Yeah, sure. I think Jeff's right in terms of these are massive trends, but with a lot of nuances, and they're constantly evolving. So I would just encourage people to maybe broaden their net of trusted advisors. There are a lot of firms out there, both established and newcomers to the market, that are looking at the challenges. And I think the wider you can cast your net to really understand what's under the bonnet. You don't have to become the expert, but you need to have the basics of how networking, how cloud networking works. What are the key drivers? And I think by talking to a lot of the community in the vendor space, but also in the your peers, you'll start to get different points of view. And I think when anything is like fast moving, the more information you can get, the better, right? Information and knowledge is power. So yeah, I think these kind of events, and I think hopefully as the world's opening up, we'll get together in person as well. I think just sounding out the market, and you'll quite quickly find the major issues that you need to be aware of. So
and Monica, you're closest to the cutting edge research, to the sort of trends of what's going on in the industry. So what do you see? Do you think that the marketplace is convinced that managed services is the way to go, or do they still need convincing? And are there any other trends that you see that we haven't covered that you think people need to be aware of?
I would say, overall, the industry, capital markets has always been a super, secret squirrel industry, right? Everyone always felt they had to do everything themselves if they could, if they had the money. That attitude has really changed. There is a huge recognition now that there are elements of the business that are key to our success. These are competitive edge. These are things we have to invest in and really understand. There's going to be this middle ground, as Eleni said, things that we have to kind of understand what the drivers are. We have to know enough to keep people honest, but we can start working in partnership with others. And there's other things that we want to outsource altogether. And if you look at different segments of the industry, the buy side in particular is really embracing outsourcing. So we've done research across a range of areas. Even with front office trading, there's a move to outsource that. And there are business cases that justify that. So we're seeing lots of outsourcing in the middle and back office. That's been going on for a while. So I think that attitude shift, and when you think about cloud, that initial feeling is you're losing a little bit of control, but you do gain a lot back from it. That has encouraged, I think, the industry to form a lot more consortiums or collectives. It's great to hear this new focus on sustainability from the industry. There's a number of partnerships you can join to learn more about cloud, and there's things like learning, working together to come up with a script that helps you securely launch a node. Things like that are not going to be differentiators for your business, right? But it really pays to have people work together on those things. So even something as simple as that. So I would encourage everyone to talk to your peers in the market, see where these consortiums are, see where these sort of industry groups are. There are more of them than you probably realize, and definitely participate in those, because there's lots of really great information being shared. People have a much more open attitude, and I absolutely do see, our research has shown that this trend toward outsourcing, trend toward working with managed service providers, really partnering with their solution providers, is gaining ground. I think the difficult thing is knowing, which bits of the business are really the ones you want to focus on. And sometimes that's a decision around your business model. Do you want to be close to the client, or do you want to be the one developing products that other people can use? So there's some questions you have to answer. It's not as simple as it sounds. But once you've decided what your business model is, you should then be able to really focus on those differentiators, and that's where you put in your time and energy, and hopefully help go to the industry for the other things. I would also plug Celent. In addition to being a subscriber, we do have a lot of information for free on our website, so anyone can go and register for that. And we have blogs, we sort of comment on news sites. So there's lots of providers like us as well that you can take a look at and try to follow on what's happening.
Fantastic. Well, we're coming towards the end of our time, so it only really remains for me to thank all of the speakers. Thank you to Monica from Celent, thank you to Jeff from TNS, thank you to Eleni from Equinix for making time to share your valuable insights today. As I mentioned, you can download the report from the handout section, or if you don't, I think it's going to be circulated afterwards. So if you're still trying to make a decision as a firm whether to buy versus build, you've got the decision framework there to have a look at and hopefully help guide your decisions. I believe a recording is going to be made of today's event as well. So if you have a colleague who missed it and would like to see it again, we'll be circulating that as well. And obviously, we'd love to see you at any of our future events. So do stay in touch with us all. But for today, thank you very much for joining us for Build versus Buy, and look forward to seeing you again on a future event.